This is the last video of the week, and we are going to apply what we learned in this week 2 to the GREMLIN case. It is, as I told you several times, like tennis and golf. After some lessons, the best way to learn is to practice, practice, and practice again. I have a small surprise for you at the end of this video to improve your handicap or your ranking in financial analysis. I hope you will like it. Let's take a look to GREMLIN profit and loss statement balance sheet in 1996. First, to calculate some fixed asset ratio. We cannot unfortunately make any comment on the age and state of the fixed asset, as we do not have the gross fixed asset and are therefore unable to compute the ratio that we discussed in the previous video of gross fixed asset divided by net fixed asset. But we can look at the net fixed asset turnover or productivity by calculating the ratio sales over net fixed asset. As you see on the slide, in 1996, this ratio was equal to 7,545 divided by 816, which is 9.25, which tells us that this company is not in a very capital-intensive business and requires few fixed capital to operate. Every euro of net fixed asset generated in 1996 9.25 euros of revenues. If we consider the investment policy and the ratio of capex over depreciation, capital expenditure divided by depreciation, we see that it was very much higher than 1. In 1996, look at the figures, 397 divided by 207, that is 1.92. GREMLIN in 1996 has invested in fixed capital 1.92 times its depreciation, which is perfectly in line with the fast growth experienced by the company. So even if GREMLIN has a low capital intensity, it needs to invest to follow the very high speed of its growth. Let's turn now to the investment in net working capital. As you see, on the asset side, we have inventory of work in process of 539. In fact, 539,000, because as you know, all the figures in the case are in thousands euro. An inventory of finished good of 430, which leads to a total inventory of 969. Then we have accounts receivables equal to 919 and some other receivables of 50. On the liability side, we have 557 of accounts payable and 779 of other payables or other accruals, tax to be paid, social securities to be paid, custom duties to be paid, etc., as we call them in the previous video. Therefore, the net working capital is equal to 969 plus 919 plus 50, the receivables, minus 557 and minus 779, accounts payable and accruals, which gives a total of 602,000 euros. And the ratio of net working capital compared to sales, you remember the definition that we had in the previous videos, net working capital multiplied by 365 divided by annual sales, turns out here to be 602 multiplied by 365 divided by 7,545, which are the sales. And this is giving 29 days. If we look at the details now and the components of this net working capital, let's look at DSO first, days of sales outstanding, the average collection period, which remember we define as accounts receivables, multiplied by 365, divided by annual sales. That is 919 multiplied by 365, divided by 7,545, which is 45 days. What about DSI? The days of sales in inventory. This is equal to 109 days. And finally, DPO, days of payables outstanding, the average payment period to my suppliers, and this turns out to give you 150 days. And now, to conclude this week, and this hard work that we have done, my surprise. Please do the same calculation for 1997 and 1998. And try to interpret the figures that you will find. Try to look at the trend. Try to find what is abnormal, what is logical. Together, we'll go through the numbers in our live session and we'll try to make some sense out of them. We have now ended our week 2. Having covered the investments of the company, the capital employed by the firm, the next question is in pure logics. How do we finance this investment? And in the same pure logics, this will be the topics of our next week. So, see you next week. Keep practicing and keep having fun.